Good afternoon this Thursday, March 30th. Tomorrow, the big USDA stocks and acreage report. But let's just pretty much call it the NCAA version of the bracket card to get filled out, because you could get something right and something else is so far off, it'll blow up being right. And so it's an interesting day tomorrow with a lot of volatility. We're going to walk you through some concepts and ideas that might occur through this report and what's changing the landscape. And then in regards to what is expected tomorrow, let's refresh your memory. Corn, we're looking at nearly 91 million acres, pretty much what the USDA Outlook Forum came up with back in February, but it's this wide range of guess. I know there's some outliers as high as 92.5 on the corn, but such a big guess really creates for surprises tomorrow, and probably leaning more friendly on surprises than probably bearish. Soybeans there too, we could get a shocker on the bullish side. I know the average guess is up about 700,000 acres from the February outlook and last year, but they're not even added in here. I think FBN came out at 84.5 million acres. They didn't even put them in here. So shocking surprises come from there. The all wheat number, there too, as the numbers as far as what the USDA put out back in their February outlook, 48.85 million acres spring wheat, which is the important one right now. That's the one that's going to go in. They're looking at just a little bit over 100,000 acre increase from last year. So surprises tomorrow galore. And here's what will add to surprises. No matter what the corn acreage number is, we have to find out how much is going to get planted, because about a little over 20% of all the corn production is right in this area that's getting inundated with moisture, besides the eastern part of the Midwest that's getting rains. But this, X marks the spot, that's all snow. Continuing to snow. This is through next week. There's another storm. There's a storm this afternoon for the next 24 hours, and then cumulative with next week, Tuesday through Thursday. This mess comes in here. Well over a foot of snow in some areas. We zoom in. This is the Black Hills out here of South Dakota. But look at this productive ground here. Going to pick up maybe a foot and a half of snow. This is cumulative for tomorrow, Friday, and also next week's snow. But when's this going to end? We need to be able to get in the fields here by the end of the month of April, and the small grains go in first, and then comes the corn. And we've got the prevented plant date up in this range is May 25th, but other farmers keep going, especially if they're not working with federal crop insurance. They'll just keep rolling until early June yet. But I know a lot of corn's getting returned to get shorter maturity varieties because they're already in trouble with trying to get maximum yield out of some longer date varieties. So we'll see how that plays. Today and yesterday, May corn stalled at the 50-day moving average. This is on the May contract. Now we're going to go to the continuation, which is still the May contract. But recall back in March, we predicted that we'd find a third wave low. We were looking for 615 to 620, came in at 606 and 3/4 exact. And then we said, watch for a three-wave rally to occur as a wave 4. And we said we should at least get up to the 200-day moving average. Well, we're here because we did the measurement to 655. You take this leg, add it to when you find your bottom, and add it, and you get 655. Well, the high's been 655 and a half. Now, C's, here's the catch. C's are known for being extended at least half the time. So if we go an extension of 1.5, that's why in the newsletter yesterday I was saying we could still get this thing up into the low 670 range, something around 670 to 675, and that would be your fourth wave. But here's another catch. We could turn into like the fall top was, chop sideways for 30 days. We could turn into like how the winter high was, chop sideways for 6 weeks. And so the same thing goes until we get the corn planted. We could make, if there's a bullish spike here, we could pound here for a while, for weeks, until things give up finally and we find our price. But something I noticed today is it's 2 days closing above the 200-day moving average. One would think, well, that's bullish, we're going higher. Not necessarily. I went back in time. The last time we were able to do two closes on the opposite side of a 200-day moving average and then fail was back in May of 2022. So what happened back then, it came down, closed below the 200-day moving average for 2 days, and then exploded. And so the reality is this doesn't tell us for sure we're heading higher. We have to see the data. Tomorrow it's like an NCAA card, bracket card. What's going to blow it up? It could be bullish and still be blown up by something else. So we'll see. But the point is, we are getting close to a recovery rally that, may take time to play itself out, but we're in the bounce of this break. And this goes back to the long-term charts explaining how we got here in the highs back 2 years ago. December corn, Here too, we had a recovery that started. We anticipated the 650 level would bring in some support. And now tomorrow, if there's some bullish number on corn, 585, 590 is going to be a tough nut to crack. It also lines up with previous lows, comes into this trend line and moving average. It's not to say it can't go through it. We could hit it as a wave A recovery, do a B wave pullback, and then a C wave maybe into June or something like that with weather. But for now, I would anticipate any strength is going to get cut off there, especially when we look at this thing as a big picture. You know, our high occurred in April of 2022. You had your first leg down. There's wave 1. Here's wave 2. Now maybe we're completing wave 3, and then we're going to do an A, B, C, 4, and then come on down again. We'll see here how this plays out. Typically, wave 3 should have been the same length as this, and then we should have went lower to about the $5 mark and then get our bounce, because in true form, wave 4s are not supposed to exceed wave 1s. But for right now, we could still be in wave 3 overall, and now we're still getting a recovery bounce before wave 3 finishes off and it's completely subdivided. So what did this all mean? I just said corn will probably not get through 585, 590 tomorrow, and we'll have some troubles. Okay, take that away from everything I just said. On the soybeans, well, soybeans have, for now, slippage have pressed above wave 1. This puts this suspect that this count is even correct. I brainstorm with a lot of Elliott Wave guys, and they're all frustrated. This thing keeps changing. It's soybeans being soybeans. And with prospects, if this is bullish, if they show a light bean number tomorrow and the stocks isn't bad, and we close higher again tomorrow, more specifically above 1488, then we're likely going a lot higher. I'll tell you why, because we've got to go back to the count. The low was in 2019. You had a wave 1 up, a wave 2. Explosive wave 3 with the U.S. troubles and South American problems into the spring of 2021. There was your wave 4 pullback, and then wave 5 was into 2022. Okay, so now your wave counters are going to say, now we need an A, B, C correction down. Okay, well, it looked pretty much self-explanatory. There's your A. We're going to work out some kind of B. Looks like that's the top, and now we go. Well, the strength comeback here is quite interesting that they're allowing everybody another opportunity to sell. So this means we have to do a recount. And if this is now actually labeled the A, the big A, and we never did complete our upside movement, we put the big C up here, you can start backpedaling how this thing played out. That means subdividing. This was a minor A, this was a minor B, and now we're doing an A, B, C to complete the larger C. I know it seems confusing as you break this up, because as this B was done, it subdivides into another A, B, C. And so what did this all mean, all this gobbledygook? It means tomorrow, if these beans close over 1488, and more importantly, the $15 psychological range, we do have a change in trend date for the April 3rd. Don't know how explosive this is or how this is going to play into the mix, but it implies soybeans could probably still get on to that $15.75, $16 range we were talking about back here, trying to get the two legs to match up off of the lows. And this high never really was completed because it never went to its extension. It never went to the prior high. The fact that it didn't do it would tell you it's very bearish for beans. But why are we coming back? We have to say tomorrow's release of the report will answer a lot of questions. And if it's bearish beans because corn acres didn't max out, well, then obviously beans are going to struggle at the $15 mark, and that it was very bearish that we put a top in here. So I'm trying to condense this as best as I can and explain it in the best layman terms without all these guys that talk in hyperboles and big adjectives, and you wonder, what did he just say? Okay, let's see what tomorrow brings. Anything under $15 for a close is bearish. Kansas City wheat. We've been saying since the 60-day cycle low came in late, we've been waiting for a low, came in 4 days late. We said look for at least an ABC recovery rally. Over the weekend, I stated that 890 would be a bugger as it matches up with the left side here, because a lot of bears will try to play out some kind of head and shoulders formation. But I think it's too early to put our high in. We have a 6-day cycle in late April, early May to come into play. I think this is subdividing on the C leg, just like the beans did. We could correct in here. I mean, it can just continue higher now if it wants, but if it corrected, I would say 840 to 845 will hold this market for a turn back up. You can even see it on the 4-hour chart. Correction, and nothing do I do here is to time scale. You can just see something in the 840, 850 range would then create a turn back higher, and then I would anticipate something into the latter part of April when we score our high, and I would not be surprised if we were to take out the February high, but it'd still be some Fibonacci retracement of last October, the fall high, to the low we made in March. Fibonacci-wise, I could see something up in the 9.5 range, but we'll find more details on that as we get through tomorrow's data. On the U.S. dollar, we are getting precariously close to major support that needs to hold for the year. We break down here. This will be bullish for commodities, but what cards are they going to pull out of their sleeves here? The Fed over the coming weeks, we shall see. They're on check that they say they're going to raise rates again in May, but that is yet to be determined by more economic data. Next week, Friday, April the 7th, is the next jobs number. And so the oil has been finding a nice recovery since our projected low of March 21st to the 22nd. She hit the low. She is now turning higher. Watch out for big resistance coming in here at about 76.5 to 77. This will probably get checked. Of course, notice in the past, once in a while it tags it. Usually you get this crowding of the purple line, but what has been happening in this bear market and all of these is you crowd it 2 closing sessions, and then by the 3rd session, they're collapsing. You know, they can get 2 closing sessions, then it breaks. They just can never seem to hold it. 2 closing sessions, then they collapse it above the purple line. So we'll see how this plays, but wouldn't surprise me. One more little trip down, some banking crisis in the early part of April, and then we'll see what kind of bottom that puts in. But we should be starting that seasonal lift into May and June. If you would like to see more information like this, along with our morning texts, subscribe at heartlandinvest.com for a 2-week free trial.